Good morning, Home Smart. This is Rebecca Wyatt with AdvisorNet Financial Partners. Looking forward to meeting all of you and introducing the strategy of using a cost segregation study to free up cash flow in your investment properties. Please join us for the Real Estate Roundup on Wednesday, July 31st at the Biltmore location. Can't wait to meet you.
Mile radius.
We completely understand.
Yeah, everybody has their 5 mile radius.
Not Peoria, Illinois.
Right.
And Nancy, do I have your permission to add you to our database?
Sure. I'd love to learn. Even so.
And we are live on Facebook, everybody. Welcome to Real Estate Roundup. How are you doing today?
Doing well, thank you. Thank you so
Excellent.
much for having us this morning.
Thanks for coming out. We've got you guys for 2 sessions on the calendar now.
Yes.
That's great. Super. So tell us a little bit about your company.
So AdvisorNet Financial Partners is located in Peoria off of Lake Pleasant Parkway. We're across from the Peoria substation, kind of a little niche. We were there before the community was built, and it kind of just grew around us.
Okay.
So we've been established in the community for quite some time.
Cool.
At our firm, we have a combined experience of well over 60 years with a certified financial planner, a CPA, a certified financial analyst, as well as the advisors, all working together for our clients.
Great. Well, we're so happy that you're here. And Dave actually introduced us to you.
Yes, he did.
Yeah,
Dave's
great.
a great guy. We
He really
appreciate
is.
the referral and getting us connected here.
Yeah, well, this is great. Okay, guys, jump in. You can do whatever you want. I think we all know each other.
We're waiting for the slideshow.
We're waiting for the slideshow to boot up. Okay, great.
Okay, so while we're waiting for the slideshow, I'll just give you a little bit more about us.
Great.
So AdvisorNet Financial Partners is a unique boutique type investment firm with having all the expertise that we have in one house. It allows us to not only create a financial plan for our clients, but also to implement that plan once everybody agrees upon where we're going. Having the resources that we have sets us apart from other brokerage firms who have a captive relationship. We're able to work with other professionals and partner together and come up with the best plan possible for our clients. We have a staff of about 10. Some of them are seasonal workers, that's why I say about. But one thing that is unique to us is that we are all working together for our clients. So it's not, here's the plan, here's where we think you should be, here's where we think you should go, now go talk to your CPA. We actually have, if you choose to work with all of us, we have that CPA in-house who's able to lend that tax advice and make sure that the plan that we come up with is the most efficient plan for you, for your family. It's great when we're doing legacy planning or just helping somebody manage their current situation, whether it be a 401k saving for retirement or during retirement.
Cool.
We have a culture of client first. It's our mission to provide the best service to our clients. We, again, don't have that captive relationship, so if we've run into a particular situation where the client needs additional expertise or alternative investments, we're able to find the best match for the client in the situation and facilitate that plan once everybody agrees upon it.
Great.
So a little bit about our firm and where we're going. While we have consistently grown to meet the evolving needs of the clients, we have preserved our core values. Clients always come first. Integrity is irreplaceable. Quality is the measure of our success. And the best financial advice is the result of experience and teamwork. We really drive home on that teamwork. It takes many hats, not just one, to come up with an efficient plan to help our clients get from point A to point B.
It sure does.
As we are sitting here today, I have David Andrews with me. He will be, he's the CPA on our team, and he will be facilitating our conversation about cost segregation studies. The cost segregation study is a tax saving strategy that allows real estate investors to free up their liquidity in their rental investment properties, oftentimes saving them thousands of dollars. But I will let David tell you more about that.
Excellent.
And trying to figure out how to look at all of you plus the camera.
Well, you don't have to look at the camera. You do not have to look at the camera. You can refer to it or just kind of, however you guys want to do it.
As I was thinking about this presentation last night, I had the most unusual memory pop into my mind. I remember when I was 14 years old, I was participating in a basketball tournament. This was, before alternate possession and before the three-point line. So 2 seconds left, there was a jump ball at midcourt. Our team was behind by 2 points. So I get the tip, just a little bit over half court away, I shoot, it goes right in, we go in. If we had a three-point line, I would have won the game. Otherwise, we went into overtime and went on to win. But it is a sweet and satisfying feeling to be able to contribute to a winning team and to help the good guys win. And so I get that when I was explaining cost segregation to a client and telling them how we could defeat the IRS, if you would, and basically save him thousands of dollars. It's kind of a similar type feeling as as making that basket when I was 14.
Wow.
But
that must be something that everybody still remembers to this day, I would imagine, huh?
well, I'm probably the only one that remembers that.
Oh, okay. People still tell me about my dad's baseball games when he was in high school. I mean, people still talk about these things. They probably still remember. You might be surprised.
If it had been the final game, other people may have remembered, but it wasn't even the final. We lost in the final.
Did you? She made the basket. That's great.
But anyway, what cost segregation is, when I first started in public accounting, I had a friend of mine that worked for a CPA firm. He was an engineer. And you think, what's an engineer doing working for a public accounting firm? But when you take a building, this building, typically if an investor buys a residential property, the person doing the taxes, they'll take a percentage of that and allocate it to land, and the rest they say is building, and they write that off over 27 and a half years. But it's not all building. There are parts of that building. In this building we have carpet. It would still be a building if we didn't have carpet. There's upgrades. There's, in a residence there might be a washer, dryer, appliances. There's other items. And so we don't need an engineer anymore to go in and do a cost segregation study to identify those costs, those things that can be written off more quickly than 27 and a half years. Because up until a few years ago, that was viable for a commercial building because it costs thousands of dollars to do a cost segregation study. Now, we have some access to some programs that we can identify those costs and reduce the cost by to 10% of what it would have cost previously for a commercial building. And so we identify those items that might be written off over 5, 10, 15 years, 7 years, and with the new tax act, some of them can be written off immediately. And so, getting money, more is better than less, and sooner is better than later. And so, as you can write off those expenses sooner, you reduce your taxes sooner, and you can take that money and do other things with it. And so you can defer the tax on that. And the other thing is, you'll say, well, I'll owe some taxes when I sell the building. If I take that depreciation and write that property down, but you're taking the depreciation as an ordinary gain. When you sell the property, it's a capital gain, and so there's a tax difference there in the highest tax bracket sale. Am I making sense so far?
Absolutely. Yep. It's kind of fascinating, actually.
Let's say you buy a commercial building and you decide to do a lot of improvements, like paint, lighting, that kind of thing. Would you then recommend doing a cost segregation study on that type of, if you just put a bunch of money into it for those kinds of improvements?
If you're putting that money into it, you're identifying what those things are to start with.
Anyway. Okay.
And so if you keep track of that, what you don't want, I just had someone say, they bought a building, did a lot of improvements, and they said, and their bookkeeping person said, you know, the loan was for $320,000 loan. I said, I know you didn't spend 300, you know, this was, some of that was just upgrading your office space. And so then, but they had not kept track. So if you keep track of what your expenses are, and if you're putting those expenses in, then you know what those different costs are. You know you spend so much for carpeting, so much for painting, and
Okay, so that doesn't really apply then.
now, say you bought that property a few years ago. You didn't buy it in 2019. You bought it in 2017 or 18. The IRS recognizes that the rules on depreciation when you sell a property is the IRS looks at the depreciation allowed or allowable. So if you didn't take that depreciation, they're going to assume that you did take it and reduce the basis accordingly. You know, they don't just take the depreciation you've taken, it's allowed or allowable. So the IRS will let you catch up. Once you realize that you haven't been doing it the way they want you to, they allow you to do a catch up. And so you can do your cost segregation study. You can look and say, you know, I should have taken this amount of depreciation. I only took this amount of depreciation. So you can take that difference once you've identified it in the year of the study. And so that helps you, and so you have that catch up. So there's not only the cost segregation study, there's also calculating the difference in depreciation, and then you file a form with the IRS requesting a change in accounting method, because the IRS says you have to get our permission if you're going to change an accounting method. For depreciation, they've given you some procedures, and you see if you follow these procedures, the change in accounting method is automatically approved. And so as long as you jump through all the hoops, they're happy to let you do it, or at least they let you do it.
How far back will they let you do that?
As far back as there's not a time limit.
From purchase?
It wouldn't make sense if the property is by now full. You would probably only want to go back if you held the property, say, for less than half of its depreciable life, because otherwise you're probably taking that depreciation anyway.
Right.
And so the benefit is in the difference between the depreciation you should have been taking and what you actually took, and if it's mostly depreciated, it's a timing difference and you've already taken it.
Right.
Okay. But they'll let you go back, well, the law changed in 1987. And so you can go back to 1987. It's fully depreciated right now.
Yeah. Yeah.
So it doesn't make any difference. But probably, if you have a property in the last 15 years, it might make a difference. It might make a difference because then it's only about half depreciated. Does that answer your question?
Yeah. Yeah.
And so you think, you know, as I said, you might owe taxes when you sell the building, but that's a capital gains rate. That's not an ordinary gains rate. And if you bought it in a prior year, you can do that catch up and do the change in accounting method, and then you have the information that if you have to replace windows, air conditioning, carpet, you've got that broken out already. As I said, when I've worked before in public accounting, I worked for some national firms, and they had an engineer. They had people that did this, and I said that cost, you know, multiple thousands of dollars. With the software that we now have available, there I have on the PowerPoint, the little one that you can't read. There's a 2-page questionnaire, and it basically says how many square feet, you know, and it goes through some of the things you might have, what kind of floor covering you have, what kind of lighting, you have washer, dryers, etc., you know, what kind of utilities. That's on page, I think it's page 6 on the handout there. And so it takes about 15 minutes to fill
I'm
out.
sorry, some of those copies may not have pages.
Oh. Okay.
Well, I tried to do double-sided, and then it didn't, and then I stopped it, and then I was short of.
Okay. Well,
Well, thanks for trying.
since it's small enough on here, you can't read it anyway. It's a 2-page questionnaire. That's and it takes 10 to 15 minutes to fill out for a rental property, and then we can feed that in, to our software, and you get a printout of, this is the cash savings that you have, and the difference, and then it gives you, and then the segmentation gives you, several different lines there that breaks out all the different components in that segregation study. And as I said, that's, unless you have better eyesight than I, that's too small to read anyway. on this, but you do have that, so it saves you money on the catch-up, it saves you money on as you replace those different components. And typically, say if you have a $200,000, say you have a duplex you purchased for $200,000 in 2011, the additional deduction you might be able to take would be, say, $18,000. So about a $4,500 net present value, on the tax savings. Or say you have a single family rental you purchased in 2013 for $300,000. Doing a cost segregation study, you might give you an additional $25,000 deduction, and a tax savings of maybe $7,500. Now, I had a client that I was showing this to, and he had sold his home in California and bought multiple investment properties when he moved to Arizona. And so he had, I'll say, a dozen properties, and he had enough write-offs. With the passive activity, I don't know, you may not know the tax rules, but you can only take a $25,000 loss. But he had enough loss from that he could max out his loss for 2+ years because of the multiple properties that he had. The other example that they have here is they have a tax basis of $400,000 you bought in 2014, the additional deduction would be $28,000. So basically, the higher the price of the property, the more deduction you're likely to get. The software that we have is set up to be able to work up to $500,000. So we're not looking at commercial properties, we're looking at residential properties. Residential properties up to 6 units and up to $500,000. If it's beyond that, then you probably need to hire that engineer that's associated with an accounting firm and do a cost segregation study. Now, one of the beautiful things about this is because you can do this, you can do a cost segregation study and take that at any time. If I know I'm going to have high income one year, I can time that, do a cost segregation study, and take those deductions in a year that I know I'm going to have high income. If something happened and the spouse got a bonus or whatever, and so you can time that deduction. Or if your income is pretty steady and you don't have a lot of fluctuations, but you have some money, say, in your IRA, and you want to convert that, you want to take that money out of your IRA and put it into a Roth IRA so you can take it out later with no tax, then you can do that cost segregation study if you have some investment properties, take that deduction and use that deduction to offset the tax that doing a Roth conversion may generate. I may be speaking a foreign language, but that's probably a topic. Roth conversions may be a topic for another day. But that is basically what a cost segregation study is, and its advantages and its blessings to the taxpayer.
All right.
Questions?
Is it something that is done yearly, or just you do it once and then that's your rate?
Once it's done, it's done.
Okay.
And so you can do the cost segregation. The cost segregation study is basically the first step, and then the second step is determining the depreciation difference. If I self-control, I'd get a 481A adjustment, and then doing the request to the IRS for the change in accounting method. But you only need to do a cost segregation study once, because once you know how those costs are allocated, that's not going to change. And you can do it, even though it's bought the property in prior years, you can do it, anytime you catch up. Questions?
That was exactly 30 minutes. Just want to say that. I think that's pretty fascinating. What other tax work do you guys do for people? Is it mainly just planning?
Because we're full service, we do the planning, but also then we do the implication. So
Gotcha.
implementation. So
As far as tax work, I've done everything from an individual 1040 to a multi-state consolidated, tax returns.
Got it.
In my ideal world, I would do LLCs and partnerships because you have a flexibility there that you don't have with other things.
Right. Wow. What brought you guys to go into this as a career, if I might ask? Both.
So my passion for helping people led me here. In the 2007-2008 financial storm, if you will, that we all incurred,
Right.
I found myself asking questions, and not only was it me, but I wasn't alone with that. Everybody else around me was asking the same questions. Pretty much, what just happened? And not being able to find the right answers to satisfy my curiosity drove me to this career. It drove me to get my certifications and to pursue the financial industry, because I've seen good and bad out there, but being able to be a resource to our community, to my friends, to my family, means a lot to me. And so if I can help even one person get on the right track and prepare now for tomorrow so that they don't get in that aha moment,
Right.
for keeping it censored there, then I am happy. I've done what I can to help the world.
And when I first graduated, I was an auditor for the state, and after dealing with some people, I decided I was on the wrong side of the law.
Right.
Working for the state.
I wanted to be able to help people and not just send them a bill.
Right.
Because some people, I can see they didn't know what they were doing, they just needed help.
Right.
And so I decided to get on the right side of the law. So
It's pretty cool, you guys. That's neat.
And then working together, we just we truly have a unique thing going here, and we like working together, which is another bonus to our clients.
Cool.
So having that open communication, and two heads are better than one whenever you're dealing with a situation. Well, we have up to 10 at times, just depending on the day that you stop by and see us. So being able to, if we run into a wall on a particular situation, there's always somebody who has dealt with it or has a little bit more knowledge than I do on the situation that is there to lend a hand.
Lastly, I just want to say, I've talked to a lot of agents about this, and a lot of them do get behind on their taxes, and they don't want to do it themselves. Do you just, so we can have a reference, do you help agents get caught up on their taxes? Or do you do that type of thing?
Just this last week, we had David and I met with a client who is dealing with taxes from 2012.
Okay.
And he has been carrying this monkey for quite some time. So to sit down, and this is step one in our financial planning. We have to make sure that you have a strong financial foundation before we can do anything else for you.
Right.
So step one, we need to clean up the past and get that monkey off his back. And we met with him for an hour. He left with a long laundry list of laundry that he's going to have to wash and get back to us, right?
Right.
And so even having that long list of tasks to do, he left with a smile on his face and a sigh of relief.
I bet.
So any of you who need help with past IRS issues, tax returns, state planning, or just want to know where you stand on your financial foundation, we would be happy to help. We're not afraid to go back to 1987 if we need to.
That's probably a closed deal.
So if you don't do your taxes, for 7 or 8 years, aren't you penalized?
If you owe tax, yes.
Yeah, interest.
Penalized, of course.
What is the interest?
That varies. That varies from year to year, and there's also some penalties also for non-filing and that type
And this
of thing.
This is where the benefit of having a CPA comes involved because he's able to barter on your behalf with the IRS and figure things out for you.
Right.
That's nice. So he acts as an attorney.
Well,
I practice law in a very narrow area.
Right.
Called the internal revenue.
Yeah.
Interesting, you guys. Well, I just think I had a CPA for a long time, and it's incredible to me, people that commit their lives to this type of, work. It's crazy. Well, what else? Nancy, Justin, Whitney, John, Julie, anyone have anything else to ask?
I've noticed that there seems to be an attitude of a more liberal taking of expenses these days. Is that because there's new laws to support that, or
An attitude.
it seems like
among the taxpayers, or
among the taxpayers, they're expensing more and depreciating what I would say less, and then aging property. I'm not seeing that happen as much.
There has been some changes in the law as far as what can be written off, and that may, that may account for what you're seeing.
Okay.
What are the changes?
With the most recent tax act, you're able to write off some of that shorter life property more rapidly, or immediately.
and it's always a case-by-case basis. No two people have the exact same tax return or IRS issues, if you will.
Yes, if two people come up with the exact same tax return, it makes me suspicious.
Right.
Especially if it never mind.
So most importantly from today, we just want to let everybody know that we're here for a resource for you. If you ever have any questions or need information on a particular item, or you run into what is this kind of event, we're here for you guys. We're here for the community. We'll help any way that we can.
Thank you.
Thank you very much.
Fantastic.
You're welcome.
Thanks, you guys.
Thank you for having us.
Thanks for coming out. Well, guys, since we have a few more minutes, does anybody want to go around the room and talk about any of their new listings or any news that they have to share? Justin?
I've got some stuff coming up, but it's not for a couple months, so
What you got coming up?
with some buyers anyway.
Okay.
That's it. I don't really have anything to report.
I just have one listing, but we just accepted at a conference last night, so.
That's great. Congratulations. Whitney?
I have a client that's moving from California to Phoenix to save taxes, real estate taxes. So I'm looking for a property up to $2.5 million. That's a deal.
I got the True North House.
They want to live around Arcadia near their father in his elderly years. So I'm kind of, I like high rises because it's a lock key and just go, and they travel a lot. So
Cool.
if you know of any good deals in high rises.
Sure. Boy, there's got to be a few things around here.
That's pretty strange.
Yeah, for sure. Do you guys mind if I throw anything else you guys want to contribute here?
Well, we're actually working with a Californian who is looking to invest in some property, duplexes, fourplexes, so.
I've got a little
We're on
neighborhood
the
for you.
hunt for that, so if you all have any
Yeah.
suggestions.
Holiday Park on 68th Street in Osborne. Yeah, 10 plexes. I'll get you some more information on
Holiday
that.
Park. Okay.
10th Street in Osborne.
It's like 64th Street, 64th, 62nd. It's still a rough area, but a lot of people are starting to buy these 10 plexes, and they're pretty inexpensive, like $500,000 for 10 units, and they're cleaning them up, and for the first time that I can remember, they're really looking nice again.
64th in Osborne.
Yeah.
They're really fixing those ones in Osborne.
Yeah.
Really nicely.
Yeah, they're looking really great. So there's a ton of them in there, and they're all by Haver, the architect. Yeah.
They're mid-century modern.
Yeah. Yep.
Oh, that's a great tip. Thank
Yeah, definitely check in there. And then we're looking for 1 acre minimum lot in Paradigm, the $1 million mark. So if anybody can come up with a 1 acre for $1 million,
Just the lot.
just a lot. If there's a house on it, they'll.
All of them are an acre anyway, so.
Yeah, and I think most of them are a lot more than $1 million. But if we could find something for them, that's $1 million.
maybe when the market tanks.
I don't think it's going to happen, you guys. Hey, has anybody noticed specifically the amount of Californians at the coffee shop, at the gym? I mean, there's so many California people moving here. It's just noticeable now. I mean, they were talking.
Cook County. That's
Yeah.
where 50% of the 268 people that are moving here a month are coming from.
It's 268. Is that the number?
That was the number. That was the number 3 like a month ago. So who knows where it's at right now? But 50% of those people are coming from Orange County and Cook County.
That's crazy.
So definitely, if you're doing relocation, you want to be talking to the people over in California. I mean, Juicy's making it really easy for people to come over here and set up shop. He's doing a good job.
Yeah.
But I put 2 rentals in the both mall. They need short term.
That's good to know.
Yeah.
No, that's good.
Yeah.
No.
A lot of business owners moving here.
Oh yeah.
A client who owns a gaming company and he's bought 4 houses.
Wow. Cool.
Well, you know, he has to buy one for his son and his daughter.
Uh-huh.
And